right, so they asked me to give you a banker's viewpoint of the ranch lending climate. Well, the word banker is a little bit of a noble name, so I'm changing this real simply to my opinion, and y'all just have to suffer through it. The good thing with the viewpoint, you can't prove that I'm wrong, but I can prove that I'm right because I've got the mic. But real quickly, we'll kind of jump in here and give you a little bit of flavor of what we're starting to see. There is some tightening in credit standards. Some of you might have leverage. Some of you, at one point of finance, most of you probably have been purchasing your assets with cash. But the lending market is changing a little bit. Whenever you dive back into that market, you'll probably find, if you haven't been in it for a while, that lenders are going to want to prove that you can service your debt. It's no longer just about the collateral. So we're seeing some tightening there. Most of that's a response to federal regulations, to a little bit of losses. But we, here in Texas, we very much appreciate strong land prices. We haven't had the rampant appreciation that we saw back in the early 2000s, but things are starting to tick up. Talking to brokers, talking to realtors, there's lots of activity out there. You guys are obviously seeing some strengthening in your balance sheets from your asset side. So we're sitting in a pretty good spot. All of that here locally is leading to a very robust lending environment. There's some strong banks. There's a lot of capital out there. There's a lot of money that's sitting still that needs to go to work. So if you're going to find some money, now's a good time to go shopping. The competition is strongest in our shorter term rates, not so much in the longer term rates. There's not a lot of lenders out there that are able to give you a really long-term fixed product, a 7-year product, a 10-year product, a 15-year fix. Those products are a little bit harder to find. But in the shorter term products, your variable rates, you get to name the game just about. A lot of this ties back to what's happening at the Fed. This low interest rate environment is exceptional right now. The FOMC, which is the Federal Open Market Committee, is holding Fed funds at a target rate of 0 to 0.25%. Banks are able to access funds from each other at 0%. That puts you in a pretty good position. But here's where the interest rate environment is now. This is somewhat of a barometer for where rates are sitting. I pulled this using the 10-year Treasury. This is a 2-year perspective. So if you're a new market entrant, you're at the far right side of this graph. And you're thinking, my gosh, I missed the low, my neighbor beat me, and rates are too high. But it's all about your perspective. Whenever you take a step back, looking at that same product, since 1962, you can see that we're still very much at the bottom. So my whole point here is you cannot go wrong. You might have missed the absolute low that we realized back in April 2012, but overall, as a borrower, you're going to come out well ahead of where you were just a few years back. I know many of you probably were accessing funds back in the early and mid-1980s. Look at that spike. What did that mortgage feel like? Fun stuff. So what does all this mean? Why the long face? Well, kind of like weather forecasters, economists, it's just a guessing game. But I'm going to kind of run through a few things here that we believe might be holding true. The first and foremost concern, I guess the main primary concern for you as a borrower, is inflation coming. Rates are at 0%. I'm a lender. I'm not real good at math without a calculator, but let me tell you, unless we're above 0%, I'm not making much money. So at some point, inflation will kick in. You will start to see rates rise. That's a given. The question is when, how much, how fast. I want to read you a quote that I pulled off the internet this morning from the Federal Open Market Committee. This is your government. Stick with me here. The committee continues to anticipate that it likely will be appropriate to maintain the current target range for a considerable time. As an investor, does that give you confidence? It's likely for a considerable time. Cool. That's definitive, isn't it? So I guess things aren't going to change for a while. So with the federal government telling you that it's not likely that things are going to stay where they are for a considerable time, do you have a great deal of confidence in that? Probably not. Now, ATKG didn't commission me, but I did create this just for you guys specially, and I'll sign this after we're done. But this is my interpretation of where we are in the market. We've got the market basket being carried away by the inflationary balloon, and essentially you've got these government controls holding it back. It's almost as if the market today is at an artificial low point. So at some point, that balloon will take off. The question again, when, how much is inflation going to cost us, and how fast will it kick in? I had the privilege last week of being able to sit through Monetary policy and its impact on agriculture and farmland. This talk was given by a doctorate of economics from Purdue. The monetary policy and its impact on ag and farmland. I'm going to save you about 3 hours of napping and give you his 3 high points here. But his guess is in 2015, we're going to start to see things change. The first monetary policies kick in from the Federal Open Market Committee, leading to a little bit of a bump. 2016, now we're rocking and rolling. Inflation's really starting to pump up. That federal fund rate will exceed 1%, bring us into 2017. So in 2017, if you plan on borrowing funds, you better get it done. You've got about 2.5 years left. Now, of course, this could all change tomorrow based on who throws a Coke bottle at a policeman in Greece, but that's the way it stands today. What's that mean for us here locally? Well, it probably won't be as bad. This will be more of a speed bump. You know, in Texas, we've got a tremendous unemployment rate. We're just about leading the nation. The energy sector's kicking off our economy. Things are looking strong. We're robust. We're having appreciating land prices. You can't be in a better spot necessarily to ride this out. So if the U.S. can outpace its predicted growth, if we can actually have some positive growth in the economy, and if you manage your balance sheet, if you don't tap into those long-term assets, pull your equity out and convert it into cash, chances are you'll be able to ride out that inflationary period and not come out too bruised. In our lending environment, you know, we're anticipating that. We're seeing continued competition. That's not going to go away. Again, those short-term rates at 0% have to move out into the market. So lenders are very, very competitive in that short-term environment. We expect your rates today to be stable for a while, but at some point it will start to bump up. So how do you get out of this thing? Well, if you're an aggressive borrower, you know, you like that short-term variable rate. 0% at your bank means a very low interest rate to you guys. That's awesome if you're aggressive, but chances are at some point that's going to come back and bite you. And I want to point out here, you know, writing out that variable, we've done some studies recently, and if you had a 10 or a 15-year hold on your money and you had a variable rate, you're going to go through the pains of a high interest rate followed by low interest rate, and you're going to ride that debt service change out. But over a 10-year period of time, chances are you came out better than somebody that went ahead and fixed for 10 years at that same beginning point. But it does come with a little bit of pain. If you're going to chase a fixed rate, if you're going to ride that variable out for the next year or two before you convert or refinance to a long-term fixed product, just beware. Because whenever your variable is going up, so are your long-term fixed rates. Just as a little bit of a side note, back in May of 2007, whenever the recession really started to kind of kick in and the Fed dropped their federal fund rate, that LIBOR rate was sitting at 8.83% versus a 3.49%. That's kind of our par rate today. That's about an average credit, but 883 versus 349, that's a big change. If you're a more conservative borrower, the more of the clientele that we try and coach through, now's probably the chance to really look at that historically low interest rate environment and grab a hold of something a little bit longer term, a 7-year product, a nice attractive 10-year product, something that will hedge your bets against that inflation. Yeah, you are risking a little bit as far as your interest rate cost versus a variable, but look what happened in that same time period. In May 2007, your fixed rate was lower than a variable rate. So just a little heads up there. Of course, if you're going to borrow money, I'm here to peddle our goods, so I suggest Capital Farm Credit. We are the largest co-op in the state. We've got about $5.5 billion in assets. We've got a customer base of around 18,000, 172 counties that we cover in the state of Texas, and we can follow you to Colorado, New Mexico, wherever your heart leads you. We are cooperatively owned, and that's our major win versus some of our commercial banks. With that co-op, you get a stake in the association. You become an owner. Just like any business venture, you get to participate in our profits, and we've been doing pretty good for the last decade. I want to show you just a real quick loan example using that same 7-year fixed scenario on a 20-year amortization. That's no balloon for you commercial bankers out there. Interest rate of 5.55, your stated face rate. Your monthly payments around $3,400 a month. In 2014, this last April, we would have sent you a check with your name on it for $7,500. You factor that into your debt service, and now you're borrowing money at almost 4%. In addition to that, we would have set aside another $9,100 for retirement at a later date, about 7 years down the road. That's another 1.86%, 186 basis points additional buy down that we're giving you. So at the end of the day, it really is a hard deal to beat, and we'd love to visit with you. And I know we've got some borrowers and some clients in the room, and I'd love to hear your success story.